We had a really solid day in the markets here today. The S&P 500 was up 0.73%. We had about 69% of the stocks closing in the green. And for once, we had a lot of those old school dividend paying companies kind of leading the way here today. It wasn't necessarily an advance with the Magnificent Seven. So in tonight's video, we're going to take a look at all of that information. We're going to take a look at some after hours movers that could impact trading first thing tomorrow morning as well. We'll take a look at our macro analysis, take a look at some different asset classes, including Bitcoin that had one of its biggest days in quite some time. And we'll see what that means for the posture of not just it, but the other asset classes that you guys have a lot of interest in. We'll then turn our attention to the trade application example, where I wanted to feature a healthcare stock with several decades of dividend increases under its belt, but in the short term, it looks like it's primed for a move lower. So we're going to do a bear call spread on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 24th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and repost on these Market Outlook posts and other content. Last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And it was quite a nice session here today. Last week, of course, ended a little sour as we headed into our options expiration Friday for the month of October. And so there was a little concern going through the weekend that we might start this week off on the bad foot, but actually hasn't been bad at all. And as you can see, today was actually quite a pleasant day. You throw a dart at this particular dartboard, and chances were pretty high that you landed on a green square somewhere along the way. Some of them that stand out a bit more than others, you can see that Verizon was the top performing stock in the S&P 500 today. Of course, one of the higher yielding companies out there as well, which has been pummeled here in recent months. It was up about 9% today on its earnings announcement. We also heard from Raytheon, or at least the company that formerly was known as Raytheon. Today it's technically known as RTX, but this is the combination of the old United Technologies, which was once a dividend aristocrat that then kind of formed a merger or an alliance with Raytheon, and then they combined to make Raytheon Technologies, which is now known as RTX. But the point is, they are still a huge player in aerospace and defense, both on the military and commercial side of the business. Of course, a few weeks or months ago, whenever it was, they had an announcement that they needed to pull a bunch of jet engines off of airplanes, and that caused the stock to come down quite tremendously here, like a lot of dividend-paying companies recently. But today, getting a sizable chunk of that back as they were up about 7% today. So they were one of the top 3 companies in the S&P 500. We see another dividend stock that has been in the news for all the wrong reasons here in recent weeks and months, and that is NextEra Energy off to the right-hand side here. That is the largest utility company in the United States, at least from a publicly traded perspective, and its stock has really been hammered here lately as a result of its affiliation with its sister company, its master limited partnership that had been cutting back on some of its growth forecasts. But anyway, today got another nice little rally here, up about 7% upon their own earnings announcement here today. Coca-Cola was also in the news here today. Of course, a dividend king in this particular case, one that we talked about a couple of weeks ago when I mentioned that it had actually hit the blue zone of the Market Scholars dividend stair-step chart for the first time since 2020. It didn't stay there long, only for a day or two, popped right back out. Well, today, another nice little pop for the manufacturer of pop, at least if you grew up in the Midwest like I did. Some of you may refer to it as soda, carbonated beverage, whatever you want to call it. But where I grew up, it was called a pop. And today, it certainly did that for shareholders. It popped about 3% here upon their earnings announcement. Of course, that has a tendency to bring up their partner in crime there, Pepsi. Pepsi was up 1.32% today as well. Let's see who else was moving. We had W.R. Berkley up about 6% in the insurance space. We had Invesco as an asset management firm up about 4%. We had Fiserv, that was up about 5% here today. PACCAR stands out, it was up about 4%. GE stands out, it was up 6.5%. So there's kind of a little bit of a theme here where most of those names that I just rattled off, I think we would all agree, kind of lean more towards kind of the old line side of the equation. Even the stock directly below GE, another dividend king in this case, similar to what I had mentioned about Coca-Cola, 3M was up about 5% today on its earnings announcement. So again, all these kind of old line, old school companies, many of them interest rate sensitive, some of them having their own unique issues, as is the case with 3M and some of their lawsuits. But nonetheless, today kind of felt a little different than a lot of the days that we've been experiencing recently, where it was the old line companies that really led the way today. And it wasn't as though the growth stocks did poorly, they just weren't able to keep up with the old school companies. And we haven't really seen a whole lot of those days lately. Speaking of those large growth stocks, let's now turn our attention to the Magnificent Seven. Excuse me. By the way, I feel a lot better than I did last week, so thanks for bearing with me. In terms of getting over my sickness, I've still got a little bit of sinus issues here and there, but it's amazing what a couple of good nights of sleep will do for you. So if I need to cough here and there, you'll have to forgive me for there. But fortunately, I'm on the road to recovery there, and thank you for your well wishes as well. Anyway, let's talk about the Magnificent Seven here. Microsoft was up 0.37% in the normal session here today. Now, we're going to talk about that here in just a moment because they were one of the handful of companies that reported earnings after hours here tonight. So we're going to check in on them here just momentarily. In the normal session today, Apple was up 0.25%. And so those two you can kind of see were more along the lines of kind of break even, right? They weren't major moves there, but then again, they didn't really do anything to harm the market today. So we'll take what we can get from that perspective. Nvidia was a little bit more robust. It was up 1.6% here today. Alphabet had a nice session in the intraday session, up 1.6%, but similar to Microsoft, they reported after hours tonight, and we'll take a look at it here in just a moment. But I'll let the cat out of the bag ahead of time and let you know it's not looking so good for Google after hours at the moment. In terms of the other Magnificent Seven companies, Meta was actually the worst of the Magnificent Seven today. It was the only one that was down. It was down 0.46%, and I believe they're going to be reporting earnings here within the next day or so. We've got Amazon, that was up 1.5%, and then Tesla was up 2.09%. So as we went through those Magnificent Seven returns, they didn't quite hold up to some of those old line companies that I had mentioned before. Let's go ahead and now talk about which companies were on the losing side of the equation here today, because we had plenty of those as well. You can see that the energy stocks really kind of stand out, at least to my eye, as kind of an area that sat today's rally out. So unfortunately, we looked at an energy stock in my top-down trend trading class yesterday, because at that time, energy was one of the only areas that had some sort of a uptrend in place. And unfortunately, one day later, they are showing us that on a day when most of the rest of the market was doing quite nicely, energy decided to take the day off there. So we had Exxon down about 1%, and then Chevron was actually down 2.5%. Now, for those of you that didn't hear, Chevron was very much in the news yesterday, kind of following up on a news story that we heard a couple of weeks ago. When Exxon decided to buy Pioneer Drilling, Chevron wanted to get in on the party, and they decided they wanted to buy Hess. And so you can see Hess was also down about 3.7% today. I believe that that's an all-stock deal. So those two will be kind of tied together from this point forward until the deal becomes official. And of course, there's no guarantee that it will be. There will be, I'm sure, questions asked by regulators, but I think the general tone right now is that that is the type of deal that could get done in this market environment. So we'll see if anything new emerges from that. But right now, those two are kind of tied together. So if Chevron is down, assume that Hess will be down. If Chevron is up, assume that Hess will be up from this point forward. Today, most of the oil companies were in the red. It looks like there might have been one exception right there. EQT was up about 0.62%. Otherwise, tough day there for those oil and gas companies. In terms of any consistent selling in other areas, we had a little bit more selling in kind of the healthcare and industrials area, but I wouldn't really say it was majority selling. It was kind of more of a coin flip where you had about half that were up and half that were down on the day. In the industrial space, Pentair, which is actually a dividend aristocrat company, was down 4.5%. We also saw that Equifax was down about 5% today. So those were a couple of the big losers there in the industrial space. Within healthcare, some of the bigger losers, you can see Danaher was down about 3.5%. Agilent was down about 3.5%. Insulet was down about 4%. ResMed was down about 3%. Those are a couple of the stocks that have been impacted by those weight loss drugs here recently. HCA was down about 4.5%. Abbott was down over 1%. We'll actually be talking about that stock a little bit later on in tonight's video as well. So anyway, there was also a home builder I wanted to mention. I think it was it NVR? Might have been. For some reason, I was thinking it was Pulte, but for some reason, I'm not seeing Pulte show up. So it's probably on here, but it's kind of hard to hover your mouse over the perfect little square or rectangle. But one of the home builders, and I believe it was Pulte, came out with their earnings today and somewhat disappointed Wall Street on that count. So some of the home builders and the housing related plays were down just a touch here today. Let's go ahead and pop on over now to the main part of the platform and take a look at the specific breadth numbers. And you can see here that 347 out of the 500 stocks of the S&P 500 do have or did close in the green today. So that was good for about a 69% hit rate. So not necessarily up in that 80% plus area that we like to look for as being kind of a one-sided day, but definitely tilted heavily towards the bulls here today as we are emerging from that options expiration cycle here on Friday. And by the way, some of you may have been seeing some of the statistics on Twitter or elsewhere from the Stock Traders Almanac, or maybe Ryan Dietrich or other people that kind of tabulate some of those statistics. But there's been a little buzz out there here recently that it is basically during this moment that we're in right now that the market finds its bottom, at least historically from a seasonal perspective. Now, does that mean that for sure means we're going up from here until the end of the year, this year in 2023? Of course not. Life's not that easy. But it does mean that factually, moving back throughout history, for whatever reason, there seems to be buyers that start to step into the market at around this time during the year on average. So perhaps, we have a little bit of seasonality and historical statistics on our side if we start seeing a turn in the market. And, today the market was up about 0.75%, not a huge day, but an important one nonetheless. And you just never know when one thing leads to another, just like on the downside where it feels like, every single piece of news is bad news. That can also happen on the upside. So we'll have to keep our eye on that possibility of a market rally as we now head towards the end of the year. Wanted to also bring up which companies were reporting earnings after hours tonight. Now, of course, this is one of the biggest earnings week of the entire earnings cycle, so we're not going to be able to go through all of them. But there were a handful of what some folks would consider to be more important companies, and I wanted to bring those up so that way you guys had kind of a heads up as to what to expect as we head into trading tomorrow morning. So let's come on over here. Take a look first off at the aforementioned Google, or Alphabet, if you please. Ticker symbol still Google, but the name technically is Alphabet. As you can see right here, we do have a stock that is down heavily in the after-hours session. Alphabet closed at 138.81 here today. It was actually a reasonably good day, one of the better performers of the Magnificent Seven, up about 1.7%. But you can see that that is being washed away and then some after hours as they have reported their earnings, and the market doesn't seem to particularly care for what it heard from them, because as you can see here, the bid and the ask of Alphabet right now are both below 130. So at a minimum, we're down about $8 or $9 per share after hours at this moment. Now, as I always like to remind you when we're having these conversations, just because we're down or up or anything in between, in an after-hours session does not guarantee that that's how it will open tomorrow. More times than not, it does hold, but there are rare instances where maybe a conference call, turns the tide, or maybe new information is released, or maybe there was an earnings announcement, or a dividend announcement that was made. In fact, some of you that follow me on Twitter might have seen that I just posted a couple of things after hours here today. One on Visa, increasing their dividend by 16%, and then another on Rollins, the company that owns Orkin, the pest control company, up 15%. So remember, it's oftentimes the case that when a company reports their earnings, if that is the quarter when they traditionally announce their dividend increase, they might as well just get that information out at the same time. So sometimes you'll see an overreaction, sometimes that will be corrected, but more times than not, I would say that the initial reaction, especially here, a couple of hours after the market is closed now, is what we should prepare our minds for first thing in the morning. So for those of you that may be Alphabet shareholders, prepare your mind for having a tough session here at the beginning of trading tomorrow. Some of the others that reported after hours here tonight, staying within the communications sector, Snapchat did report earnings here tonight. Oddly enough, this stock is barely moving. Those of you that follow me on Twitter will know that is somewhat of a rarity. Snap is somewhat remarkable for its ability to get snapped after hours when they report earnings. There has been probably somewhere between 5 and 8 times in the last few years that their quarterly earnings have shown a destruction of shareholder value of, let's say, 15% or more. So not just an average normal, yawner of a move, but a big move. Well, this time people may have been anticipating the big move, and they're not going to get it, because right now Snap closed the session at 971. And right now the ask price is at 968. So in other words, just a couple pennies below where it closed. It did have an initial pop, by the way. Actually, it had kind of a big move down and up. The high after hours was 12.07. The low was 8.88. And if you take the difference between those two and formulate or calculate a percentage, that is an extreme move from high to low in after-hours session. So it's a bit goofy that when it all settled out, we're basically right back to where this thing closed in the normal session. So Snap having a strangely calm after-hours session when reporting earnings. Another stock that reported earnings was the aforementioned Visa. They did report a dividend increase of 16%, as you can kind of see over here in the news items. This is a company that has had outstanding dividend growth over the years. The problem is the stock goes up faster than the dividend growth, and therefore the yield never really amounts to much. Remember, if a stock went down and the dividend was increased, then the yield would go up. But if a stock goes up at the same pace that the dividend goes up, then the yield effectively gets equalized over time. And for Visa, it has always been, or it has regularly been, a company that has a yield around 1%. In other words, nothing to write home to mom about. But it has been a runaway success, obviously one of the largest companies in the United States, and they did report their earnings tonight. Looks like a little bit of disappointment in the earnings reaction, but not anything significant. You can see they closed the session at 234.65. At this moment, the bid and ask is kind of hugging 230 to 232, so down a couple or a few bucks per share. However, the market maker move, the anticipated move here, was expected to be about $8. So the fact that it's only down about $3 means that this was a calm move for all intents and purposes there as well. So for those of you that might have sold iron condors or something more neutral with your strategy, you're probably pretty happy about that right now. For people who are wanting directionality by buying calls or puts, they're probably disappointed because there's going to be a vol crush that's probably going to come out of Visa pretty quickly here tomorrow, would be my guess. Two more stocks reporting in the after hours. Let's start with the one that's doing poorly, and that is Texas Instruments. This is a company that is somewhat well regarded within the dividend growth investing community. They've got about 2 decades of dividend growth under their belt, which is not bad for a tech company. As you can imagine, the longest dividend streaks are not from tech companies, they're from old line companies like consumer staples and utilities and things like that. So Texas Instruments is kind of grandfatherly, as it were, within the dividend growth investing community, specifically within the tech sector itself. And they did announce a dividend increase here a week or two ago. I think it was like 5%, so nothing much. But today, sadly, their stock is down after hours in a big way. You can see that they closed the session right around 147. At this moment, the stock is trading at exactly $140 per share after hours. So in other words, down $7. So that's a pretty healthy percentage move right there. So both Texas Instruments and Alphabet will be challenges for the kind of tech-oriented area of the market tomorrow morning in all likelihood. And then the final one I wanted to bring up was Mr. Softy. If you ever hear anybody refer to that, they're referring to Microsoft and what the ticker symbol is. It looks like MSFT, Mr. Softy. But Mr. Softy, fortunately, bailing out the market. And, you know, when Google and Texas Instruments are down, we need a big player to go up to offset that, and fortunately we do have that with Microsoft. You can see it closed the normal session at $330. It's trading about $11 or $12 per share higher than that at the moment in the after hours session, so a nice pop higher there in Microsoft shares here. So where that brings us with all that information in mind with the market in general is it's a pretty calm session at the moment. You can see that SPY closed the normal session at 423.63, and the current bid ask is right at 423 to 423.02. So in other words, we're down about 60 cents after hours upon reacting to these earnings in the general stock market, which is basically a non-event, right? That's a nothing burger type of a day. So at least earnings did not derail this fairly impressive rally that we saw here earlier in the normal session today. We'll see what tomorrow brings. Remember, there'll be plenty of other companies that will be reporting their earnings before the bell tomorrow morning, and so that could change the tone once again. But right now, thankfully, we're still standing on all of our feet, so to speak. All right, let's go over here to our charts now. Taking a look at our 4-grid, this is chart 4B for those of you that are premium members, Market Scholars, following along with me. Remember, if you're not a premium member of Market Scholars, next month will probably be a good month for you to become one, as we will have our annual Black Friday sale. All right, we've got S&P 500 in the upper left here. You can see that it was up 0.73% here today, so a pretty solid day. Yesterday was a low in the morning and then kind of settled out with a little bit of a loss yesterday at the close, but not as big as it looked in the morning. So that maybe was a sign that, hey, we might have an opportunity to try to get a little bit of a reversion to the mean type of a move. While I wasn't with you yesterday, had I been, I would have pointed out that we narrowly missed an oversold cluster signal. Remember, if you right-click on these charts and then go to maximize sell, you can see it kind of in a much more zoomed-in view here. And you'll notice that on yesterday's candle right here on the S&P 500, here's what the different colored lines on the market forecast look like down below. And you can see how close that would have been for a cluster. For those of you that are not familiar with that term cluster, it's when you have the green line, the red line, and the blue line all in the lower reversal zone below 20 on the same day. And yesterday you almost had it. It was about as close as you can get as they all bunched up, but they all kind of bunched up here just a hair above 20. So in other words, the psychology of that type of a move right there, remember that's a 5-day sell-off that we're looking at right there, was aggressive enough to put you basically within spitting distance of an oversold cluster signal. So it should be no surprise that we're trying or attempting some sort of a reversion to the mean type of a move right here. Now, before we get too excited about it, I always like to remind folks that just because we get a reversion to the mean type of a move does not necessarily mean that it's going to be a trend-changing type of a move. As long as we're below this falling 30-day moving average, you've got to be a little bit cautious getting too bullish, at least if you're more of a short-term or intermediate-term trader. If you're a long-term investor, that's of course a different story. Of course, I taught my dividend growth investing class earlier today, where we looked at the consumer discretionary sector, and of course we're looking for stocks intentionally that are down in price, because of course that means that all else being equal, we're getting more bang for our buck out of the income component of our total return in the future. But you do have to be careful playing that game as well, because dividends are not guaranteed, and some stocks that are in downtrends continue to go into further downtrends. And so without a crystal ball, there is no perfect way in this world. But in general, traders are more short-term oriented than dividend investors who think long-term in years and decades. Traders tend to think in days and weeks, maybe months. And as we are looking at that amount of time behind us, it can help shape our expectations for the immediate future in front of us until we are proven otherwise. And if we're looking at the immediate past here, you can see it has been fairly devastating. This has not been a good-looking chart here. So while it's fun to talk about these nice up days that we get like today, talk about the strong breadth and talk about some of the bigger movers in the market, high single-digit movers, all that kind of stuff. It's fun to talk about. But the truth of the matter is it hasn't changed the picture or the outlook for what our expectations are in the immediate future. Some of you may be wondering, well, didn't you just say something about, the calendar and how that could help save us at this moment? And the answer is yes, I did just say that, but is that the sole reason on how you trade, right? That type of information should be kind of supporting information or supporting data for your trade. It should not be the primary driver of what a trader is doing. If your charts are setting up bullishly and you also know that we're entering into a bullish time of year, it might embolden you to take on bigger position sizes or maybe shut down your short trades earlier than you would otherwise. But rarely is it going to be the difference maker that says, oh, well, we're in late October now. I'm going to stop doing bearish trades and I'm going to start doing bullish ones regardless of what the charts look like, right? You have to have the charts kind of prove it to you at the same time you're getting that information. And right now, I think we're kind of jumping the gun if that's the mindset that's out there, because the charts have not yet proven it to us. They've proven one day to us after a 5-day sell-off. In the grand scheme of things, that's not much. So, let's talk a week from now. And if we're above the moving average then we can start having that little bit more serious conversation at that time. But until then, you got to be a little bit cautious in this type of a market. They've left a lot of carcasses on the side of the road here in recent weeks as people have tried to get too bold and buy too early. It usually has not worked out for those folks. So anyway, that's where things stand with the S&P 500. Narrowly avoided an oversold cluster signal on Friday. Got a reversion to the mean nonetheless here today. But despite the rally, we remain firmly in strongly bearish territory, right? That's when the background color of the chart is that dark pink like we have right now. You have that green line in the lower reversal zone. So when it emerges out of that lower reversal zone, that background color will then change back to this light green that we saw here. But it's going to take a little bit of time for that to play out. So we'll see if today's the start of it or if today was just a little bit of a head fake. In terms of the other charts, be aware that all four of our major U.S. equity indices continue to have red moving averages. And what that means in this case, where we're using a 30-day moving average, is that price is below a falling 30-day moving average on all four of our charts. And as you can see, the pink background colors of all four charts over today's candle signify that none of these charts have bullish postures yet, not even weekly bullish postures, let alone strongly bullish postures. So while we did see a rally across the board today, it didn't change our view of the markets at the moment, at least if you're judging that through the lens of the market forecast technical indicator. With the Dow Jones Industrial Average, it was up 0.62% today. With the NASDAQ Composite, it was up 0.93% today. And the Russell 2000 was up 0.82% today. By the way, the Russell 2000 broke to new multi-month lows here as of just yesterday. Some of these others did as well. The NASDAQ did and the S&P 500 did. But the reason I'm kind of emphasizing it a little bit more on the Russell 2000 is because, remember, it was already breaking to lows before those other ones were. And there was some hope that because the selling was so aggressive during this time period right here, that this kind of 5-day rally might lead to some sustainable buying and bullishness. Again, this is another example of why you don't want to get overly ambitious if the stock is not trading above its 30-day moving average, or in this case, the index, because you can talk yourself into a lot of things when you see a market go up 5 days in a row, like, hey, this is it, that's got to be the bottom. But your eyes are telling you, no, we have not yet broken this series of lower highs and lower lows. And right now, as we look at all four of these charts here, we can see none of them appear to be in any sort of an uptrend. You know, the only thing that you could say that differentiates them, or the main thing, is the NASDAQ has been up 2 days in a row. For the others, it's only been 1 day. And it's hard to say, hey, we're now bullish after just 1 day of recovery. So, you know, again, I, as much as anybody else, would like the market to go higher. As somebody who tries to think long-term with most of my retirement accounts, I wouldn't be any happier if that were the case. But as a realist, you look at these charts and you ask yourself, do these charts look bullish? Not really. You know, you had an oversold cluster signal, by the way, yesterday on the Russell 2000. So sometimes things look so bad it's good. So maybe you had that going for you with the Russell 2000 today, but that's not really the way that you want to build upon strength, right? That is usually a little bit more sustainable. Usually when you get bullishness on the concept of it's so bad it's good, it doesn't last as long. It runs out quicker. And so you want something to build upon. Maybe we'll talk about that here after a bit when we do our 12 grid analysis when we're looking at Bitcoin, because those of you that have been watching cryptocurrencies here in the last week or so in particular know that there has been some really strong price activity there, and it wasn't like it was out of the blue, right? Last week when I was with you during this video, we talked about how Bitcoin was already stabilizing quite nicely and was acting a lot better than the stock markets in general, and the only thing we've seen since then is more bullishness. Now, a lot of that is being pushed by, you know, this idea that Bitcoin ETFs, some of the bigger players like BlackRock and even Cathie Wood's vehicles, and some of those have been applying for these spot Bitcoin ETFs. And they've kind of been tied up in red tape for, you know, years at this point, but it sounds like they're getting closer to the finish line. And so that's creating a little bit of enthusiasm around that, where there's actually kind of a reason why, you know, you can expect that there's support that is forming in some of those markets. Whereas we look at some of these other markets, like the stock markets, we don't really have a lot of good reasons why there should be support here. I talked about the calendar, but that's not what I would consider to be a substantial reason, right? You want more fundamentally strong reasons for us to get excited about stocks. But right now, we're still staring in the face of, a Fed that seems bent on raising interest rate until, inflation is conquered. We have, those rising rates that are impacting a lot of areas of the market that are interest rate sensitive and that are heavily leveraged. We have high oil prices because of what's going on in the Middle East. It seems like if you wanted to kind of write down a list of pros and cons of this market right now, you could probably find a lot more cons than pros. And so until we start seeing some other actual legitimate catalysts that can assist the calendar, we probably want to tread a little bit more cautiously than we would otherwise. But, again, just to confirm, all 4 of these charts remain with strongly bearish postures from an intermediate perspective, according to the market forecast technical indicator. And all 4 of them have the path of least resistance continuing to be to the downside as they are trading with those red moving averages that represent price below falling 30-day moving averages. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free presentations on YouTube. As I've mentioned in the past, it actually takes us about 3 hours all in to produce this video, and that probably sounds like a lot to a lot of you, and it is. It's a huge chunk of our day, right? A traditional business day is like 8 hours, and if 3 of our 8 hours is dedicated to a free video that we don't make money off of, we really have to question whether it's worth doing the videos or not. And the reason that we do that, for the most part, is twofold. We, of course, do the videos, one, to educate. We want to help those of you out there that are, somewhat newer in your journey to becoming self-directed investors. And, of course, David and I have been at this for a couple of decades plus at this point. And sometimes it's helpful to have a few pointers here and there, understanding how to interpret markets and things like that. So education is, of course, our main focus. But secondarily, from a business perspective, naturally, we want to be able to get some benefit out of it as well for giving up our time during this arrangement. And our hope is that those of you that enjoy these free presentations will be willing to click like for us on social media, or repost, or tell your friends about it, or comment, or, all that kind of stuff generates a little bit of buzz for the old algorithm, and then that can help advance David and I's business interests as well. So it's kind of one of those things where we offer a freemium business model where our main business does have a subscription associated with it, but these free videos that we put a lot of time and energy into, we are hoping are equally as useful, and we hope that they will help spread the word about our business. But whether that works or not is anybody's guess. But that is what our hope is. And thank you to the 103 of you that clicked like for me the last time I did the video. As I always say, as long as we're up and over triple digits, I'm more than happy to give you a full hour-long video, which is more than double the normal video time, as a way of saying thank you for those of you that do go out of your way to help support us. Remember, it only takes 5 seconds out of your time, doesn't cost you a penny. So for those of you that are willing to do that, we want to support you if at all possible as well. Then again, some of you may choose not to support us, or you have your reasons for not being on Twitter or what have you, and that's perfectly fine as well, right? Each one of you has to make that decision for yourself, whether our time is worth your time. And if the answer to that is that it's not worth it for you to do a like, then that's okay as well. We will understand that. I will still do the video, but in that case, if we're under triple digits, then I'll just stick to a shorter video so that way I can kind of save myself a little bit of time during those days when I'm otherwise spending so much time producing these videos. So when we're under 100 likes, I'm going to try to keep it nice and short at 15 minutes. And some of you actually prefer that, and that's okay as well. Right? To me, it doesn't really matter either way. If we get a bunch of people liking it, then that supports our business interests. If we get a bunch of people that refuse to click like, then that allows me to spend less time doing these videos, and more time can be spent on doing other projects that I have for my business here. So either way, I'm happy. Up to you if you want more or less content, but we don't think it's too much to ask for those of you to click a button for us. Thank you to those of you who do choose to do that, including some of these friendly folks right here, like Margie, and like Rich and like Matthew Mayer. How about that? Go Yotes. He's one of my old college buddies, and he's a heck of a piano player, by the way, if you're looking for some good piano music. Thank you to Richie. Thank you to Jason and to Rick and to Leah and to Dave and to Kenneth and H. Battelle and Michelle and William and VJ and John and Robert and T-Fib and Pam and NZ and Terry and Henry and Evan and Charlie and Eric and Stephen and Bob and Craig and Roger and Jean and Duncan and Payo and Prickly Trader and Juan and Ray and Ken and Curdy. The list goes on and on and on. I can't get to all of you, but I do appreciate each and every one of you that takes that time out of your day to help David and I along with this special project. All right, let's go ahead and now take a peek here at our sector selector tool. And as you can see, this is as of 10/20. So I always like to remind folks, this actually gets updated on Friday evenings, and of course our premium members get immediate access to it, but I do oftentimes show it here during these YouTube presentations for free on a delayed status a few days later, assuming we're up and over 100 likes. Obviously, this is the type of thing that gets eliminated if we do only do a 15-minute video here, in the future. So it just kind of depends upon that as well. But generally speaking, if we're doing a full-length, hour-long video, then I like to show you this, even though it's on a slight delay here of a couple of days. The reason I like to show you this is because it tells us a lot about what is in and out of favor within the market. Many of you are familiar with the concept of sector rotation, but if you're not, it's the idea that money flows from one sector to another, and while sometimes they might all go down together, like we've seen here more recently, there'll be other times where they all go up together as well. But what we're looking for are changes within the sectors where we're actually seeing evidence of money flowing more aggressively into one area of the market than the other. If you can figure that out and master that, you then get to set yourself up for the concept of a rising tide lifts all boats. In other words, if you can figure out which sectors are doing well, you might be able to find a stock within that sector that is not necessarily the best stock out there, but surely because it belongs to that sector, it might go up for you anyway, right? It could also work the opposite way. Naturally, there is no crystal ball in this business, but it is at least an approach towards the market. Even if it doesn't work perfectly, it's useful for a lot of people to think about the markets. And as you can see, energy, which is basically your oil and gas stocks, they did remain at the top for the 12th week in a row. Remember, this is a rolling 3-month graphic. So next week, if energy stays at the top for one more week, you will have a clean sweep of that brown line and dot, or whatever you call that, up at the top, fully across. Right now you can see it's nearly complete. You do have energy there in the second place position exactly 3 months ago, but starting next week, this week of August 4th will be the first week that we see, and then of course we'll add October 27th, here in a few days. So it's possible that energy will have the rare clean sweep there. It kind of reminds me of, if you played that game Connect 4, this kind of feels like a much bigger version of Connect 4, where in this case you do have them all the way across on the row, in this case all the way across on the top, which is quite the feat and is not something that is easily achieved. But we are in a kind of peculiar market here where not a lot of stocks have really worked, quote unquote worked, right? The ones that have had specific attributes associated with them. And one area of the market that does continue to work right now is that the oil prices continue to rise. When oil prices rise, there's a better chance than not that stocks that get paid to pull that oil out of the ground will also go up, or at least outperform their peers in other sectors. And that's kind of where we're at right now. So that's not really anything new. We've been talking about that for a long time now. Something that is new, however, is in the number 2 position there, and that is communication services. You can see that this orange ball and line here, if you tracked that backwards in the last 3 months, the highest position before this week, you'd have had to go back to the end of August when communications managed to get into that top 4 in that 4th position, that 4th slot there. But that was the only other time other than this week that communications has been in the top 4 during this 3-month period of time. It's a little surprising there. It's not that, there's tremendous outperformers there. But of course, you have companies like Alphabet and Meta that have done okay. But it is a reminder that this is an equal weighted approach towards the sectors. It's not market cap weighted. So we have to remind ourselves that Alphabet and Meta are going to be viewed equally as companies like Comcast and Disney. In other words, smaller companies within communications there. So that's probably part of the story here as well. But nonetheless, you can see that finally communication services are making a run for it. Remember last week when I was with you, we had a huge day out of Netflix. That was the same day that we had a huge day out of AT&T. Fast forward to where we're at today. Remember, I mentioned earlier that Verizon was the best performer in the S&P 500. So that little piece of information gleaned on October 20th probably wouldn't have been the sole reason you would have bought Verizon here before today, but perhaps it was part of the story, right? So you can see the value in understanding when money is rotating into sectors, you can put that information to use in creative ways. And again, I'm not here to suggest that that would be the sole reason you would buy Verizon, but it might be one of those situations where if you were on the fence yesterday about whether you should buy Verizon or not, and then you learn that communications had gone up to the number 2 position last Friday and surged above all these other sectors, that might have been just the little push you needed to get into it. And today you've got yourself a 9% winner there in Verizon. Of course, there's plenty of examples that could go the opposite way, but I'm just trying to explain how this information could be useful for those of you that want to utilize it. Anyway, with communications making its way up to number 2, that means that a few of the other sectors had to find their way heading a bit lower. That included information technology, that included industrials, and that included financials. All 3 of those had to move down 1 position to make room for the big leap from number 5 to number 2 for communications. Materials stayed exactly the same in the middle. Healthcare stayed exactly the same in the middle. Discretionary made a move, and for those of you that listened to my video on Thursday, you would have heard me mention specifically when I said I would personally be surprised if real estate and utilities stayed at those levels with discretionary below it. And the reason for that is what I knew from last week, Monday through Thursday, was that REITs and utilities had really had a tough go of things. So my hunch, my gut feel was that they were probably going to have to move down, and that's exactly what happened last week. Real estate, utilities both moved down a notch again. That allowed consumer discretionary to move up. So I think down here it's more of a story of these 2 were just so bad. It wasn't necessarily that discretionary was so good. Discretionary was probably about average last week, but REITs and utilities were terrible, so they needed to be moved back down. Discretionary makes its way back up just a little bit, but still in the bottom 4 of the rankings there. Remember, when it comes to the health of the overall market, my preference would be to have technology, communications, and discretionary leading the way. So right now, we actually have communications and technology up there, all of a sudden with communications especially making its move. But we do have discretionary kind of lagging there because those are the 3 areas where you have all of your magnificent 7, right? Communications is where you find Alphabet and Meta. Technology is where you find Microsoft, Apple, and Nvidia, and discretionary is where you find Amazon and Tesla. So Amazon and Tesla, if they can get their engines revving a little bit, I think that would mean good things in the bullish side of the pros and cons list that I had mentioned before. In addition to the seasonality, you could have maybe a little bit of support from sector rotation theory as well. All right, let's go ahead and pop back on over here to the main part of the platform. And let's do some 12 grid analysis. So we'll get started here with chart 5A first. So let's talk about our bottom 2 corners as we typically start off this conversation. Of course, one of the biggest thorns in the side of the market recently has once again been interest rates, just like it was last year, right? We've been kind of dealing with this for approximately a year and a half, maybe 2 years at this point. Prior to that, interest rates only knew one direction, and that direction was down. And so it's feeling like we're in a complete opposite world here in the last 2 years compared to the last 2 decades previous to the last 2 years. And that has caused a major jolt within the stock market and fixed income markets naturally. So today, interest rates were pretty steady. Technically, they were up just a hair. We closed at 4.84% on the 10-year Treasury yield. While that's not a big move, one direction or another, one thing I will say about it is I think the market is happier when this number is below 5%. Remember, last week we were pushing through the 5% level, and that was at the same time the stock market was down 5 days in a row. So I kind of think the market in its own mind right now thinks of the 5% 10-year Treasury level as being like its kryptonite. If it's up there, then all bets are off in determining any advancement of stocks from that point forward. If interest rates can stay below 5%, I think maybe there's a hint of optimism in the air. It's not an outright bullish environment, obviously, but there's at least hope that eventually this rise in interest rates that's felt so one-sided here recently can start cooling off. So I want to keep my eye on that big round number. Us humans like those big round numbers, and we kind of think in big broad strokes around those numbers. And in this case, 5% is one of the bigger ones that you could think about out there on the 10-year Treasury yield. So if we stay below 5%, I think there's a chance that we can find stabilization in the stock market. If we wake up a couple days from now and interest rates are surging beyond 5% again, then in my book, all bets are off, and in all likelihood, the stock market is going to struggle mightily under those conditions. So to me, that's a really, really important number right now. So with today being kind of a nothing burger in terms of direction for it, it basically just held the line from yesterday. Obviously, the posture did not change. We do remain with a strongly bullish posture on the 10-year Treasury yield. Obviously, we're way above the rising 30-day moving average right here. In fact, there's a massive air pocket. So it's going to be a long time before you could make the claim that interest rates are no longer in an uptrend. So don't hold your breath. It's not like something that's going to happen tomorrow or the next day. It's going to have to take probably weeks for us to get there. But again, 5% is, in my mind, a very key level for this market right now. So on a day when we had, basically calmness out of the Treasury yields, you can see that we actually did have a pretty big day out of the dollar. The good news is the dollar was not enough to disrupt the market's advance today. Sometimes that happens as well. I think the market itself has been more concerned about interest rates than the dollar in this current era, but it doesn't mean that has to be the case moving forward. But perhaps that was a reason why the market was willing to advance today despite the rise in the dollar. But that was, a pretty nice little move out of the dollar, up about 0.57%. Remember, traditionally, when the dollar is strong, we then find that commodities are weak, and that relationship did hold today. Gold was down just a touch, 0.01%. Oil was down about 2.5%, so a little bit more aggressively there. So it's actually a 3-day sell-off in oil, and that probably explains what we saw in our heat map earlier when pretty much all but EQT oil stocks within the S&P 500 were down today. So now that I see the oil chart, that makes perfect sense. You can see not only did oil close lower for its third consecutive day, but importantly, you now are below a falling 30-day moving average, right? So this has been an aggressive enough move here where it's actually bent the moving average lower. So that happened pretty quickly there. So we do want to keep our eye on this, because if all of a sudden we struggle to get back above that moving average, then it's possible that some of those oil stocks will start cooling off. Now, I don't want to make it sound like that's a bad thing. If you own a bunch of oil stocks, for instance, yesterday in my top-down trend trading class, we bought an oil stock. It's not necessarily good for that, right? Those are kind of later positionings, right? Of course, we also own other oil companies that we bought weeks or months ago. So those ones were fine. But if you've been, buying oil companies over and over and over again up until recently, then you're probably going to be a little bit more concerned about this behavior here of oil all of a sudden. Now, keep in mind, that could actually be a good thing for the market in general, right? In the past, it had been the oil stocks that have been up and most other sectors down. If we enter into kind of an opposite world, so to speak, when oil stocks are down and the rest of the sectors are up, then that means that 10 out of the 11 sectors are doing well. That's probably good for your portfolio, all else being equal. So while it may sting for some of the oil companies that you own, it may very well mean good things for the rest of the market. Remember, oil prices being high is one of the things that the stock market doesn't tend to like, because oil plays a role in most of these other sectors, whether it's transportation or the production of plastics or whatever it is. When oil prices are high, they have a tendency of pinching profits. When oil prices start going low, it means that profits can expand, all else being equal. So yeah, it might be tougher for oil stocks specifically, but in general, that can be a good thing for the overall stock market. So oil all of a sudden does have itself a weekly bearish posture here at the moment and trading below a falling 30-day moving average, which is actually the very first time in 3 months we can say that, right? As you see with this red moving average here, we have not seen a red moving average at all up until today. This is literally the first time in 3 months here. So that is new information there. Gold, despite selling off the last couple of days, it has not been aggressive selling like we've seen with oil. And so gold had made such a massive move higher in the last 2 weeks, just after that Israel news, that we do find that gold continues to retain its strongly bullish posture, and it's still above its rising 30-day moving average. So it's been a while since we've been able to say that the gold chart actually looks stronger than the oil chart. Remember, for much of 2023, that has not been the case. So this will be interesting to see if we have a little bit of a baton toss here, or a handoff. For those of you that were on track teams in high school or what have you, you know that the baton is that stick that you see in the Olympics that one person will give to another, and then they'll go around the track with it, right? So we might be having a baton pass here from oil to gold. And if that's the case, there might be some money to be made there, because many of those oil stocks are up a lot over the past several months, and many of the gold stocks are down. And so there could be some repositioning within those that like to trade commodities there. So keep your eye on that possibility. I'm going to keep my eye on it as well. So gold remains strongly bullish posture there. Let's talk about Bitcoin now. So I brought up Bitcoin with you guys on Thursday. In fact, I brought up Bitcoin and cryptocurrencies in general in 3 of my recent top-down trend trading classes. We've looked at Bitcoin and Ethereum and things like that, because those have been part of the area of the market that have not been breaking down. And that's an interesting relationship as well, because remember, there was a time not so long ago when Bitcoin was kind of perceived as like a hypercharged NASDAQ. If the NASDAQ was going up, Bitcoin was going up. If the NASDAQ was going down, Bitcoin was going down. But that didn't seem to hold here within the last week or so. Bitcoin has gone straight up, and the NASDAQ has only gone up 2 days in a row and is still down considerably from where it was a week ago. So Bitcoin seems to be unhinged from the NASDAQ at the moment and is trading on its own merit. And as I mentioned earlier in the presentation, one of the key talking points about the cryptocurrency market right now is the expectation that we're about to see a whole lot of ETFs be approved by the SEC when they were hung up in red tape over the years for so long, that basically will give access to Bitcoin to a lot more people who don't just want to buy the coins individually in their own cold wallets or what have you, and instead gain access to Bitcoin through an investment vehicle in their brokerage accounts, somewhat akin to like GLD, right? Like this chart for gold that we're looking at here, it's ticker symbol GLD. GLD is an ETF that does not track gold mining companies. It's a ticker symbol that tracks the price of gold itself. And so that opened up the gold markets to a lot of people that didn't want to store a bar of gold in their house somewhere, instead wanted to have a proxy for it within their brokerage accounts, and they can now just buy and sell this ETF to, take advantage of that proxy. Now the same thing may be able to be achieved with Bitcoin, and that's creating a little bit of enthusiasm out there in a market that had almost been forgotten about, right? It's been kind of interesting here up until the last few weeks. It's not like people were ranting and raving about Bitcoin the way that they were several years ago. And it seems like there was some stability here, right? When we got our bullish, not necessarily bullish posture, but where we got our green line on the market on this chart here, so this is the 30-day moving average, that was on September 29th. So that was a month ago, right? And a month ago in the stock market, we were a lot higher. A month ago in Bitcoin, we were a lot lower, but it was already showing signs that a rebound was in store. Obviously, you never know for certain, but there was a reason that we looked at cryptocurrencies 3 times in the last several weeks in my classes, including just this last Monday, the day before this massive candle right here. It was on a different cryptocurrency. Nonetheless, that one went up a lot today as well. But it's been really interesting to watch Bitcoin take off. This is one of the bigger moves you've seen in quite some time. So anyway, we're all of a sudden up here above 34,000. In fact, it had touched 35,000 in its move at one point along the way in the last 24 hours. And the last time that it was at $35,000 was back in 2022. So it's been a long time, right? It kind of seems like this thing is back from the dead all of a sudden. So obviously a strongly bullish posture on Bitcoin, and price is well above its rising 30-day moving average there. Our bond charts are all continuing to have the strongly bearish posture, but as you can see, they were all up a touch here today. So they're trying to build upon some sort of a bounce. We'll see if it can be trend changing or not. Right now, I have my doubts, right? If interest rates can break down, that's a different story. But if interest rates remain elevated, it's going to be hard for any of the bond markets to gain any traction there. But a reasonably good day for the bond ETFs, despite them continuing to be in that bearish posture. Foreign stocks were also up here today. EFA was up 0.57%, EEM up 1.28%, but similar to the bond markets, they remain with strongly bearish postures and are below their falling 30-day moving averages. Looking at our sectors now, you can see that it was a positive day across the board with the exception of energy. So that was the one that I had pointed out to you on the heat map that looked like it was underwater with just one stock closing in the green, all the rest in the red. So no surprise that XLE was down 1.4% today. But hey, we'll take it if it means that all 10 of the other sectors were up, and that was the case here today. The best performing sector, let me just see, it looks like it was actually utilities. Like I mentioned before, NextEra Energy was up like 7% today, and since it's the biggest utility company in the S&P 500, it has a much bigger impact on this particular product XLU because it is also market cap weighted like the S&P 500. So this was the NextEra Energy effect, with utilities leading the way today, up about 2.5%. All right, let's talk about our trade application example now. I'm going to pop on over here to chart 3A, and I had hinted at which company it was going to be earlier, but in case you didn't catch that, the ticker symbol in question is going to be Abbott Labs. This is ticker symbol ABT. This is a well-regarded dividend king, so fairly well-known in the dividend growth investing community, but like a lot of dividend stocks, has been really out of favor here lately, and looks like that continued today. So I wanted to do something bearish on a day when the markets were up, just like the inverse of that last Thursday when the markets were down, I did something bullish, right? So for the same kind of reasons, you get better pricing when you're doing things like that, right? I was selling puts, a bullish trade, when the markets were down last week for you. Today, when the markets are up, I wanted to do something bearish because I like to keep some sort of balance in this market outlook related portfolio. And so I would rather do bearish trades on bullish days, especially if it's not some sort of a trend-changing bullish day. And today, as I mentioned before, was not trend-changing by nature. It was simply reversion to the mean for the overall market until I see otherwise. So with Abbott Labs, as you can see, it also had a reversion to the mean move going into its earnings announcement last week. You actually had two oversold cluster signals right here and right here that led to our reversion to the mean bounce. But like so many of those bounces, it's now stalling out right at the underside of its downward trending 30-day moving average. So notice that the moving average has been red going all the way back to right here, back in the first week of August. So this has been a tough go of things for Abbott Labs. It does have its bearish near-term posture at the moment, which is represented by that light pink background color there. Notice that it was down 1% today on a day when the stock market did really well, right? So that's underperformance on a one-day basis. And then you can see all these colored labels up at the top here. All of them are red. None of them are green, meaning that on all of these different time periods, this stock's price is down. Now, to be fair, it's only down 0.42% over the last year. And if you were to add back in the income you would have received from the dividend, that would have gotten you back above break even on a total return basis, but still underperforming the market in general. And generally speaking, those are the types of companies that you try to pick on with bearish trades, as I'm about to suggest, or not suggest, but to talk about right now. So remember, these trades are already done. The trades get done during the market session. So that way I get an opportunity to send those trade ideas out to our premium members on our Telegram channel. So that way they can consider the trades for themselves before the stock market closes. And that way they get a little bit more information, a little bit more benefit there than people who are just watching the free video on YouTube later that night. Anyway, what I did here in this case was selling a bear call spread. And I sold the, I believe it was the 99-100. It was the November contracts, not the Decembers in this case, but the Novembers. So it was the November 99 that I sold and the 100 that I bought. That creates a credit spread because the 99 is going to have the bigger premium associated with it. So when you sell it and then you buy something with a smaller premium, aka the 100 premium is smaller than the 99 premium, then that creates a credit up front, right? Because you're paying some money out of the pocket for the 100 strike, but you're taking in more money than that for the 99 strike. That creates a credit up front that is yours to keep. And we usually target a return on risk of about 30% when we're doing those types of trades. For those of you that are not familiar with selling bear call spreads, what we're hoping to accomplish with this particular trade is that Abbott Labs will be trading below $99 on the third week of November. And if that's the case, then that 30% return is ours free and clear. If that doesn't happen and Abbott Labs, for whatever reason, whether it's the seasonality of the markets getting bullish or whatever, if it spikes higher and goes above 100, then I'm covered because I would then own the $100 call. Now, that doesn't necessarily mean that we're going to make money on the trade if that happens. It just means that we won't continue to lose more and more money if that stock were to continue to go up. Remember, if you were to short sell this right now instead, and if you weren't using a stop loss or what have you, each and every consecutive dollar that it would go higher would lose you more and more money. So that is the benefit of selling a bear call spread in this case. You have a defined risk. You know what your worst case scenario is the moment you place the trade. You can have a fairly good odds of success in the trade because we sell out of the money spreads and you get a reasonable return, in this case the 30% that I had mentioned. So basically this is just an idea that is a continuation of the downtrend that we've seen out of it for the last 30 days plus, but was really spurred on by the fact that we had a bounce down and away from the falling 30-day moving average on a day when the stock market did really well. So it's kind of like a poker tell there that this stock really is not doing what you may want it to do. If I'm not mistaken, we had kind of a similar setup with Oracle here a few weeks ago. That one I did do a short sell on, and for those of you that followed along in that trade, you'll know that we successfully closed it at max gain. This one is not like that because we don't have a target price down below. All we have to do is stay in the trade for a certain amount of time and hope that it remains below 99. So whether that means it's down at $80, whether it's at $90, or whether it's right here where it's trading right now at 95, doesn't matter. Any one of those three conditions would come to the same outcome, which is a max gain trade. Where that gets disrupted is if this thing gets above 99. Then all of a sudden we've got to have some losses involved in that. So we'll cross that bridge if and when we need to, but that's the idea for right now. Basically identifying a downtrending chart, trying to take advantage of a momentary reversion to the mean move. So that's what I had for you here tonight. I appreciate you guys checking out tonight's video. Remember, if you did get value out of it, I ask one simple request. Click like for me there on Twitter. It'll be pinned to the top of my timeline. Otherwise, you can always find the tweet in question by looking at the little Twitter icon directly below the video that you're watching on our website. You can access it in the Twitter link within the description area of the YouTube video for those of you that watch this directly on YouTube. And then you can also find the tweet in question with the little Twitter or X icon on the emails that we send you as well. So any one of those four ways will get you to the same point. But I appreciate you checking out tonight's video. As far as I know, David should be back tomorrow from his vacation, so we'll welcome him back. And then one way or another, I will also see you guys on Thursday night for another video. For those of you that are my premium members, I'll see you bright and early tomorrow morning for factor-based swing trading. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.